Entrepreneurs, angel investing, and venture capital. This is a rapidly expanding and evolving part of our financial markets. For many entrepreneurs, this can seem like a complex and daunting landscape. For investors, navigating a wide array of opportunities can tax even the best resourced operations. In this mini-series, Kevin Monserrat of Consilience Ventures asks, what's next for the venture capital industry? He follows the startup journey, first from the perspective of the entrepreneur, then the angel investor looking for early investment opportunities, and onto the VC funds looking to deploy larger levels of capital. Indeed, many features of the broader capital markets, such as data, analytics, and speed, will become increasingly important in this space. Kevin asks how each group is dealing with issues such as liquidity, sizing within portfolios, equity dilution, and the increasing volume of data. Each guest outlines their own experience of how they got into the business, how they've seen it develop, and what the future holds. Along the way, they provide a wealth of insights for everyone, from experienced practitioners to those who are new to the industry. In this first episode, Hobson, an entrepreneur turned angel investor, focuses on the startup, discussing liquidity, the importance of networking and ownership considerations, whilst maximizing support from investors during the initial stages of the startup journey.
So Graham, you're an entrepreneur. You have started a business a long time ago and you exited. Why don't you tell us a bit more about who you are, how you started, and how you end up starting a company?
Sure. So my name is Graham Hobson. I'm a technologist by profession, and I worked for several investment banks for the first part of my career in technology and working with equities and derivatives. And when I got to my mid-30s, I had two young children at the time, and I needed a service that didn't exist. And it felt like the right time for me to take some risk and to experiment and to use the experience and the contacts and the confidence I'd built up in the previous few years, and to have a go at trying a startup. So that's what I did. And the service I needed was to print digital photos of my kids, and there was nothing online and nothing on the high street where I could get that service. And like most entrepreneurs, I thought that can't be so difficult to build. All I need is a website and an order management system and one of those big print machines that you see in the back of boots. So that's what I started out to plan and do. But of course, the reality was a lot more complicated.
So what was the reality then? So tell us how you founded the team. Who were your co-founders? How did you split the company? Very early, it was your idea, it was your baby, but you realized you couldn't do it yourself because you needed more people. Tell us a bit more about that.
So I really wasn't well equipped to be an entrepreneur, particularly an internet startup entrepreneur, at the point where I made the decision. I think I told my wife at breakfast one morning I was planning to do this thing, and she laughed and said, well, don't give up your day job. And I realized that it was going to be a hard climb. I needed to write a business plan and think about how the business would function. I needed to raise money. I didn't have the confidence to do it myself, so I wanted to recruit a co-founder. And piece by piece, all the plans fell into place. But it was hard work. In the end, we took some shabby office space in Clerkenwell. I recruited a friend of mine to be a co-founder. I found two guys called Chris, one to build the website, one to build the internal order management system, and somehow we got up and running within a couple of months and launched the service.
That's fantastic. So you're saying, well, we started with friends initially, so it was my problems, and I guess you kind of communicated, you communicated this vision to your friends, and they bought into the idea, and they say, well, we're going to come full time. We're going to do that with you, Graham.
Yes, it took some convincing. My co-founder, Mark, I think he said no 3 times before he said yes. And, at the time I set up the business was the end of 99. So there was a dot-com boom going on, and internet startups were very fashionable. And to be honest, one of the easiest things at the time was to raise capital as investment. So we raised 480,000 in about a week. I wrote a very thin business plan, spoke to a few colleagues and friends and family members about what I was doing, and within a week I'd raised the money. But I didn't really have any of the downstream structure needed. I certainly didn't have the expertise and the people I needed around me, and went on this search to try and assemble a team to get everything done. And I feel in retrospect I was incredibly lucky. I seemed to stumble across really key people that were necessary with the right skills in the photographic industry, in business, in finance, and in some of the process points we needed. But I couldn't take that for granted. And for a lot of companies, I think it's difficult to find the right people to advise them in those early stages.
So it was 20 years ago, roughly. Is that correct?
Yes,
And
correct.
20 years ago, there was not that much content online where you could read everything and then kind of almost go through an academic research before being an entrepreneur. You dove in, and you had to figure out. So how did you know how much you needed to raise and then how much equity you needed to give away at that time?
So that was one of the lucky relationships I had. On that day, I told my wife back in '99 that I wanted to go and do an internet startup. We were due to go and have dinner with her cousin in London that evening. And I knew her cousin's boyfriend was something to do with pub accountancy. And so we went along and had a wonderful dinner, and I explained my idea. And he said, "Oh, actually, I am an accountant, but I've raised money for startups, and I in fact was even a NASDAQ listed CFO at one point." And he said, "Let's meet for lunch and I'll guide you through the process. I'll take a little bit of equity and guide you through it." So I had somebody who was able to put together a private placement memorandum. In the end, I raised all the money and it was my contacts, but he provided the structure and the guidance about valuation and how much to raise. And I remember him saying, "I think for a business like this, you need to raise between 240 and 480,000. And we raised the high end of that limit, and it wasn't enough at all. But you have to kind of, set the bar somewhere.
Yeah. Okay. Well, so first of all, you say that you had to pay that person some equity, right? How much did you know that was the right equity incentive for that friend? Did you put a finger in the air, or did he propose something to you? And
he proposed something. He said, I can't remember the exact amount, but I think he said something like, "I'll take 2% of the equity in order to provide, part-time CFO services and whatever you need over the first couple of years." And I said, "Sure." Felt good to me. In the end, I ended up doing two similar deals. One to bring in an amazing chairman, who happened to be my dentist cousin, but also the previous managing director of Dixon Stores and PC World, and had run Boots Photographic for years, and was an amazing industry person for us to connect with. And he also got 2 or 2.5%. And we brought in one strategic partner for the company that was an established fashion pro lab in the industry, to guide us through all of the inevitable learning curve that we'd have to go through in setting up a photographic business.
do you mind asking me how old were you at the time when that happened, when all of those things happened at the same time?
I was 35, and at the time I felt very old, because there was this image of .com startup entrepreneurs being, 22 in their Converse,
Reminds
sitting
me
there in
today.
Silicon Valley. And actually, I remember reading some research at the time that said the average age of an entrepreneur was 35, and it makes perfect sense to me, because I think you're at this kind of midpoint in your career thinking. You've had enough time to get some experience and confidence and some savings. You're thinking, am I going to do the same thing for the next 15 years, or do I want to change things? And I think it's that ideal switch point of, do I change paths now? So any younger, I wouldn't have had the experience for sure. And any older, I might have probably been too nervous to try it.
And I was going to add one point to that, is that you were also very well connected because you had the top CFO, a top chairman, and some other folks that could come in for some equity. So you were already well connected. What do you think you were lucky at the time to have that level of connection, being that networked? And do you think that everybody at 35 should be that connected? And how do you even place this in the world right now where we are all living, we're all working from home and create less connection?
So I remember thinking at the time there was an incredible amount of serendipity, because there were probably about between 5 and 10 things that happened like that, where everything seemed to fall into place. And I thought, gosh, I'm really lucky. And now I realize that you create your own luck, or at least you improve your chances of success by going out, talking to other people, explaining what you're thinking about, refining your ideas based on feedback, and establishing those connections. And, I'm a great believer in karma. Last year during the pandemic, when there wasn't much advisory work going on, I decided to just do free coaching for anybody who needed it. Any company, any individual, both what would normally be commercial and pro bono. And I really enjoyed doing it. I learned a fantastic amount, and I ended up creating some very useful connections then as well that have turned into commercial work this year. So I think you have to get out there and talk to people and make connections. And I remember talking about this when I've given talks to students before. The word entrepreneur, of course, Kevin, it literally means to take between. It's somebody who makes connections between things, and I think that's the key element to entrepreneurship.
No, I love it. So profound. What do you think that the word entrepreneurship is changing, or do you think the opportunity to be an entrepreneur has grown since you've exited and you're now taking another role?
I think that it's changed a great deal. When I started out, entrepreneurship was not a standard path to choose. And I felt like we had to learn so many things. And like you said, there wasn't information online, and there weren't so many books to read on the subject. It just felt like I was going my own way and I'd figure it out. These days, entrepreneurship seems to be more of a career choice. And I think people feel under a huge amount of pressure to invent some amazing idea and come up with some amazing business plan. And those things are very difficult to do. In my case, I had to wait for the inspiration to reach me. And I didn't sit in a room and think, what can I do online? I had a business or I had a real family need that wasn't being met through any other means. And so I thought, let me go and do that. So on one hand, I think things are harder now. There's a lot of pressure, a lot of people involved in the sector, and all competing for resources and ideas. On the other hand, the tooling and the building of these services is much easier than it was. When we started out, there was no AWS. We had to buy our own servers and, in fact, install them. We had like this 2-man lift of a storage unit for all the photos. No SaaS services. Everything had to be built from scratch. In fact, when we started to think about marketing, we had a real struggle in how to make people aware of our service, because I'm sure many people today wouldn't understand this, but there was no Google. Google did not exist, so there was no AdWords. There were no social networks, so there was no such thing as a Facebook ad or an Instagram ad. So it was a very different landscape for building and marketing your service. And these days, those things are much easier.
Yeah, so effectively there are some great documents out there, some great research that are showing that. I think Kaufman Fellow published some years ago now a research which was supported by Andreessen Horowitz, if I'm not wrong, and they were effectively explaining that actually the cost of being an entrepreneur is now 10 times cheaper than what it was maybe a few decades ago, maybe 1 or 2 decades ago, and you seem to be agreeing with the fact that it's now easier, but because it's easier, there is more competition, and you need to be, because the competition has increased, then you need to be even better than if you were on your own in kind of a blue ocean strategy. Yeah, no, very, very, very interesting. What are you doing today? What is it that you are doing today now that you have all of that experience? Tell us about who you are right now in the context of, the pandemic and how you support entrepreneurship.
So I'm lucky to have had 3 exits in my career so far. The first one is obviously the most significant because it was the company I built and managed for many years, although I had lots of help along the way, and sold in 2016 to private equity, and then but I stayed on with the company for a while and left in 2017. So that's the one I feel the most direct involvement in, and that was, personally very rewarding and very informative, and I feel like I learned so many life skills in going through that journey. I had a bit of imposter syndrome, and I took some time out after the exit, and I thought, I wonder if I can do it again, or at least help a company to exit. So I went into a much more challenging, smaller company that was effectively a turnaround situation, and realized that I couldn't wave a magic wand. There were many things about their technology and processes that were suboptimal, and yet I wanted to demonstrate to the investors and to the CEO or the founder that with the right tuning and the right positioning and the right growth reactivated, we could sell that company for a good value. So I did that. It was a supply chain tech business, and it was a very, very hard 20 months that I was there, but we did sell that successfully, and that happened just at the start of the pandemic last year. And then we had a spin-off company that was part of our group, but we separated off, and that IPO'd earlier this year. So I feel like I've had, amazing results and luck and success, and I'm very, very pleased. So these days I spend my time doing advisory work. Some of it's paid for fintech companies, SaaS companies, financial data companies, a few clients. I spend about 20% of my time on pro bono work. I'm somebody that feels very passionately about lack of opportunity or a growing gap in opportunity in the UK, and I'm been campaigning for more progressive taxation because I think that people have accumulated a lot of wealth. Some people have, and we could do more to contribute to society. And I think there's a perception that when you create a successful company and sell it, all the rewards should be yours. But there should also be a recognition that you've built that company on the foundations of societal investment in education, infrastructure, health, innovation, and the whole economy lifts if the economy is vibrant and the country is prosperous. And so I think entrepreneurs in particular can do more to feed back into society once they've had a good result.
Do you think everybody can become an entrepreneur? Do you think because we now have, as you said, better education, probably a very safe environment to live with, do you think that everybody is going to be able to turn entrepreneurs as an entrepreneur? And is it something that we should kind of try to reach, or should it still be fairly exclusive given that the risks and the mental energy, the mental drain? And so
I think entrepreneurship as should be available to everyone who wants to go down that path. And to be clear though, the path is to not accept the status quo, to not accept that the world you live in is ideal. It's to say, this doesn't work for me. I might be strange, but this doesn't work for me. So I'm going to come up with a better solution for me. And if other people like it, then my business will succeed. And a lot of people look at the world and say, it's fine. I don't need to change anything, or I'm happy to go down this well-trodden path. And for those people who think differently, they should be free to pursue an entrepreneurial path if they want to. Having said that, I think lots of people have great ideas but struggle to refine them into something that is a workable business model or an executable plan. And these days I see many decks, possibly like a dozen a week, from really talented and exciting young entrepreneurs, but they haven't grasped the essence of what it is to create something that is a solvable problem, a desirable solution, and an executable plan. And that's where I try and work with them to say, okay, but maybe we can change it in this direction. Of course, all businesses need to have this unifying the product need, the user's need, the commercial model, and an executable build plan. And getting all three of those things in sync is quite difficult. And so I think one thing that young entrepreneurs need, or whatever age they are, is access to people to help them and guide them. And I was very lucky. I had the right expertise at the beginning of my company, and I wouldn't have succeeded without it. The right guidance, the right past knowledge. And I think that's what people need access to.
You use the word, I think, luck, and I think it's quite very humble and refreshing. I'm amongst the ones who believe that luck takes a big part of what we do. We can be prepared, but if without the opportunity, no matter how prepared you are, you're not going to be successful. So what's the weight, what's the proportion, if you were to try to put a percentage, what do you think the percentage of luck is in the process of doing a successful company that is exiting well?
Well, it's huge. I mean, I get people who ask me, how did I do it, or what steps did I follow, and there's this belief that if they can reproduce exactly the same steps, they can get to the same outcome. I mean, of course, the steps I took, many were wrong, but I somehow had a way of getting back on track, and they were unique to my journey and my outcome. But what I did reflect on was that this feeling of luck helping me at many points along the way, or serendipity, was fed through my own actions of for those people watching this who've read The Lean Startup, they'll know there's a principle that you try and go through these very rapid build, test, learn cycles to figure out, is the thing you're about to launch into, is it going to work or not? And can you learn in 1 week whether you need to change it? So running a business where you're able to make very agile decisions quickly, it gives you a better luck probability or luck percentage, because you have a chance to correct so many more times than if you fix your course and just keep executing down that one path. So luck is about being able to rebalance, to adjust, to make corrections, and it's having access to the right people to guide you. And so I think rapid testing and small cheap experiments were one key part of our execution, and the other thing was constantly talking to other people. I'm somebody that kind of overshares a lot. I talk to people and I tell them all my problems and all my exciting ideas, and they give me feedback, and those conversations were so helpful, because even if I'm talking about their problems or their challenges, I would go off, have a coffee with them, listen to their problems, come back to my desk and think, oh, I know how to solve that problem now. So I think sharing with people your struggles and your ideas gives you an opportunity to rethink things through in your head, and makes finding a solution much easier. So those two things served me really well. Rapid cycles at work whenever we were building, and having lots and lots of external conversations and talking to the right people.
Do you think the proportion of luck reduces with the maturity of the businesses, or do you think it remains constant?
I think the luck diminishes. If luck is the random element that can kick you into the right direction, yes, that diminishes, because as your business grows, your products become more mature, your build cycles become slower, your goals become more fixed. And the people you work with, even if they're really super high quality people, they're more well known to you. They're Exactly. Probably your employees or your advisors or your board members. And so there's less randomness there. Of course, by the time you get to that period of less luck, hopefully you've got more commercial results to show for it.
So it feels to me that it's almost a very good explanation um, why there is so much money into Series A, Series B companies, because they are typically looking for traction, whether it's commercial or other mechanisms to or metrics to perform to analyze business traction. But of course, there's less luck and more predictability, as you said. Do you think that if we manage to reduce the luck early stage in the process, do you think that we can open more capital coming to this market, given that it seems to be driven by commercial traction? And do you think there is an opportunity to bring more capital even earlier in the process of raising of starting a company instead of getting to the 1 million, IIR, 1 million pound AIR as the traditional
I
VC would do?
I do. I mean, so since my first exit in 2016, I've been more involved in angel investing, and I think I started out with a big flurry for the first couple of years of helping other entrepreneurs and enabling them to benefit from the backing and the investment from angels, as I did. I wanted to give back in some ways, but I also wanted to learn about angel investing. And what I learned is it's really hard. And actually all investors talk about the J curve, where their portfolio goes down before it starts going up. But my J curve was more like a bottomless pit. And it felt like I had way too many failures and things going off track. And I learned that my selection criteria wasn't at all fit for purpose. I was basically backing passionate entrepreneurs who were all in with an idea that they could explain to me. And that wasn't enough. I learned over the last 5 years that there are many more conditions that I need to check for before making an investment that do seem to be working much better in the last couple of years. But I think there's a huge opportunity to invest in seed stage companies. I think there's obviously a lot of volatility there, but there are huge gains to be made as well. And there are many companies out there that have amazing ideas and good teams. They need help to execute, but with the right guidance, they can really succeed well. And I think traditionally the seed stage is unrepresented in professional investment and relies too heavily on angels, but there is an opportunity for more professional investment to flow in there.
What a nice conclusion before our next show with Simon, who is going to be talking about angel investing. Graham, it's been a pleasure. Thank you very much. It's been very insightful. I always learn every time I talk to you. So thanks very much again for being on the show, and we'll speak soon.
My pleasure. Thanks a lot. Bye-bye.